Let's discuss the most important part of this series, which is volume, consolidation, and liquidity. We can call these the three musketeers. They pretty much come together, joined up, and we're going to try to break each one down and try to understand what it means. Let's start with volume. This is a huge topic, but there's different kinds of volume. Okay, volume, all we say is order flow volume, which is just the volume of orders flowing into an exchange. OFV, we call it, but there's certain volume of orders. Now, you have centralized exchanges like the CME in Chicago, and you have decentralized exchanges, unregulated, which are most FX pairs. Anybody can be a broker these days. These are the decentralized exchanges, and currency futures is traded where? On these centralized exchanges. So this is where some of you can use order flow volume data and actually see the actual orders coming in, the bid and ask data. For example, 6A is Australian dollar. This is the symbol for it, but that has volume, and that's a data feed from this exchange, but a regulated one. Okay, and then you have pretty much most of these FX pairs and most of these brokers are decentralized, and they don't really offer reliable volume and order flow data, bid and ask data. But just we want to differentiate, it doesn't really affect the explanation here, but understand what exchanges you're using and understand where your volume is coming from, where your data feed is coming from. Notice how this one is FXCM. You have a lot of brokers and a lot of feeds, but this is not the interbank market, which is what the big boys use to trade with each other. They have their own VIP market. This is not the volume of their orders. Okay, so understand the feed you're using and the volume, and volume will become much clearer if you understand this part. But let's look at this: retail traders, brokers, dealers, primary dealers. This is how the infrastructure of the system operates. You have these brokers offering the pricing to these retail traders. Retail pricing they give them. Where do the brokers buy it? From the wholesalers, and they retail it for retail pricing. But the point is, the big boys are the primary dealers here. Okay, and let me know if you can get their orders, because that's what matters. But you need to differentiate here with volume, because it's real subtle and it's a very complex topic to cover in a video, but no fluff. We're going to keep it real simple. Volume, just understand the order flow volume, the orders, and understanding where they're coming from. And there's different data feeds that show us different volumes coming from different exchanges. But most of it, it's not the IB market. Most of this stuff, most of how the banks operate through this You're not going to find it on TradingView. But let's go on to this next word, which is consolidation. We're going to get back to volume, but we need to introduce these words because Three Musketeers, for some reason, they all come together. But let's look at consolidation, and we'll talk about liquidity as well. But what is consolidation? Well, price is consolidating and stuck between two levels, maybe. And it's maybe consolidating or ranging or moving sideways. Now, why is this important? Well, because that's how these BFIs can stack their positions during the consolidation when the price is stuck in these tight ranges. This is not smart to stack a bunch of positions and price is moving very crazy. You want it going sideways in a narrow price range to accumulate or to do what they have to do. But let's simplify it a little bit more. How do you think a BFI or a big institution can buy and sell? Do you think the price drops and then they're real scared to miss out, so they then sell? Or do you think the price shoots up and then they're real scared to miss out, so then they buy? That's not how it works, okay? So let's think about how they can buy and sell, how they click, okay? You need to understand that the biggest lot sizes on the planet, that's a whole nother game. You need to think a little bit different, not a little, a lot differently, because this is how they can operate. The price will drop and we call it a collapse. The price is collapsing. It looks like it's going to zero pretty much. But somebody comes in and then they buy. And this entire collapse is completely engulfed or absorbed or bought up, however you want to see it. But this came to the origin and beyond. That is a buy click, you can consider it. Okay, buying up this collapse. Now, let's say they want to sell click. Well, when do you sell? Do they sell low or do they sell high? They sell high. So how can they sell? Is you have a nice rally. And then they can sell into this rally with a sell click. All right. And maybe this rally is completely sold off. That is essentially an entry. Now, think about if it does this and then you get another collapse, a rally sold off, and then you get maybe another rally that's sold off. This is how these consolidations form, these sideways movements. But essentially what's happening is there's a sell click and a sell click, and there's a accumulation of a sell position within the sideways movements. So as the consolidations occur, stacking occurs along with it, which is why you will find that the heaviest volume is within these sideways movements. And the huge moves that come before or maybe after are very empty volume moves. We call them empty peanuts. And most of the action is in the sideways, where it's real choppy and they go find 17 other pairs to look at instead of understanding what's going on and seeing what is being stacked here and reacting accordingly. Okay, so let's discuss this stacking, which occurs during this consolidation. Do you think they can stack buy orders and sell orders and the price goes both ways? I doubt that will happen. Okay, so essentially, even though it is some sideways consolidation, there are orders being stacked. Now, the trick is what kind of orders. If it's a bunch of sell orders are being stacked, we understand what will happen by the law of gravity. And if they're stacking buy orders, we understand what will happen. Now, maybe you get an opposite move that wipes everyone and then the real move, but the point is, within the stacking, there's a certain kind of orders being stacked. So it's either buy or sell. There is no third one. Now we have sell stacking and we have buy stacking. Let's keep it real simple here. Sell stacking, you have multiple. And when we say multiple, we mean 2, 3, or more. You have a rally sold off, another rally sold off completely, another rally sold off completely. Likely sell stacking. How about buy stacking? A down move completely bought up, maybe another down move bought up again, another down move bought up again. Maybe this is some sort of buy stacking. Now, context here is the key to trying to understand what kind of orders are being stacked. Are we in a sell zone? Key word for that is always look left. What candles are shown left? Where are we? Where are we coming from? Where are we likely going in terms of the price action? And that may give you some context, but we need all the context we can get in order to determine buy stacking or sell stacking. And obviously it'll take some experience to be able to differentiate and read the candles, as well as use our tools to help us understand this as we will be seeing now. But these two kinds of stacking are important to understand. Buy stacking, sell stacking. Let's maybe see how it looks on the charts, which is this consolidation and sideways movement. But before that, let's talk about liquidity, which just means orders. Okay, but think about this. When you have this kind of consolidation, somehow magically you have what happens? Who tends to maybe sell resistance? And maybe who tends to buy maybe the third tap of support or the third tap of resistance? The typical baby pip strategy with the stop above resistance, okay? And we can show that just with a simple sell here. well, we'll just say sellers selling support have a buildup of stop losses above here, which is liquidity. Maybe buyers are sellers selling resistance here. Maybe buyers buying support down here have their stop losses, baby pip style, below support. So liquidity builds up as we consolidate. This is really important to understand because it's part of the engineering of the system, part of the oil of the machine is this liquidity. Okay. Let's say you have a swing point like this. There is, without a doubt, liquidity below any low. There is liquidity above any high. Okay. Who do you think may be buying right now? Buyers with their stop loss below the low, which is what kind of order? Stop loss of a buyer is a sell order. Maybe there are some sell liquidity sitting below the low. Maybe someone is selling on the way down as the high forms. What is a stop loss of a seller? Maybe above the low. A buy order. A stop loss of any seller would be a buy order. So here's the point. There's liquidity below this low. Now let's imagine this came down again here and almost perfectly it made another U-turn, which I like to call a swing point, which is not one candle but multiple. So you had multiple candles down and then multiple candles up that create a swing point. Do you think there's more liquidity now or less? Obviously more. Who buys on maybe the third bounce of support again? Maybe buyers come in and let's say it goes up. Even more liquidity below that. Even more likely to get attacked. Consider this liquidity like a magnet. Okay? It's a requirement for the markets. Now, the more equal and beautiful the lows, the better the setup, and the more likely it may get attacked. Okay, now let's think about this. This is a setup of BFI looking to buy a bunch. Do you think now they can come in and buy a whole bunch? Well, not really, because maybe a lot of the planet is also buying right now. Okay, it doesn't make sense. They do not buy high, they buy low. So what typically tends to happen? A attack on this liquidity, which is a down move, and these stops of buyers, which are sell orders, may be getting hit, and some selling and selling. And now, since everyone wants to sell it, maybe now they can buy it much easier and they can actually buy way more because of this liquidity, and then you may get a move like that, which is essentially the liquidity buildup and then the attack of it before the main move. Okay, so understand liquidity and how it builds up above and below the consolidations, and Now maybe we can talk about volume, which is a really important part, and how we can use it in our trading. Understanding volume. Now, we have different profiles for volume, and we like to use our fixed range tool, which helps us take a fixed range from A to B and see the volume across that fixed range. And these volume profiles will come in certain shapes. You have a P, which can be considered bullish. You have a B, which can be considered a bearish tail. And you have a D-shaped volume, which is the classic shape of the volume and the standard distribution of it. Let's try to see examples. Let's look at this example here. After an up move here, you have a down move and then an up move and basically some sideways. Now, let's use our fixed range across this sideways consolidation area. This can be considered what? D-shaped profile, which is the most common one. What do we have sitting above and below this consolidation? Obviously, liquidity. All right. And sometimes you can take the entire range of the impulsive move and you may see here a P-shaped volume profile or a bullish tail here. Volume across these sideways range. Volume across this sideways range. Another D profile. The classic distribution. Now, we have use cases for this volume. The shape of the profile is not really what we're after. Okay, let's look at how we're going to use these profiles and the volume tool itself. There's two ways, obviously, we can use this: analytical use, which is helps us with our technical analysis, and you can use volume for execution to help you regarding your flawless execution and entry. So let's look at the first use case of volume, which is for analysis. How can we use volume to help us with an analytical use case for refining our zones? Okay, let's look at this example of refining a zone. We have a cluster of candles over here. Now, when do you want to use the volume to refine a zone? When you have a zone like this that's maybe a basing zone that maybe has too many ranges. Here's a range and here's another range, and maybe here's another range. Instead of using or doing something like this, we can refine this cluster using our volume tool and use it across the base and use this as our range. So here we are, and instead of drawing multiple zones, you can do that, but you can also use one zone and use the volume to refine the zone. Since we may be hard to find exactly where's the base, we can use the volume and cover the darkest and heaviest volume bars and consider that as our zone, and you would treat that as a range instead of maybe splitting it into multiple ranges and maybe taking multiple losses if if the whole cluster just gets, if the whole range just gets wiped, which let's see what happens here. Wicks that volume area precisely, and we like to say this is maybe for the zone wipeout, maybe it's the appetizer before the main course. So maybe you took that and went break even, but the zone clearly got wiped. So that's one way to use volume, is to refine our zones, make them a little bit more accurate using the heaviest bars. Use case number 2 for the analysis, refining consolidations, which just means we have an area of consolidation, let's say up, down over here, multiple, 2, 3, and more is really important, especially when you have here across multiple rallies, collapses on the 4-hour. Here is the area of the heaviest volume. Now, how can we refine this? By understanding there's liquidity above here and there's liquidity, like we said, below there. Okay, so when you bring these candles in, you can use this to see this consolidation, and maybe a liquidity run can look a bit more cleaner. The consolidation and the way it pops out of the consolidation can be a little bit more clearer using this volume tool, because we just want to focus on these heavy bars and what happens when it pops outside or when it goes below, how it reacts around these heavy volume bars when it consolidates. That may help us as well in our analysis, which can eventually help us with an entry, find an entry, but you can refine those consolidations. Number 3 is our POC shift. What is our POC? Point of control. It's the level with the heaviest volume, this red line here. What do we mean when we say POC shift? Okay, this is where we need to take this volume and across this point here, once you see multiple up and down movement, that's when you want to use your volume tool. Now let's say here we are. Right here. Remember, what are we going to discuss now? POC shift. Here is the level with the highest volume. Here's our POC. Notice the POC shift here. Next candle, next candle. I need you to see it when it pops outside of the consolidation or the area of the heaviest volume. And if we shifted this, we saw that before this rally, a lower price level for the PLC, and then after this rally, we see a higher level for the PLC. So that's called a PLC shift. Now, what did we see after that? We saw signals that printed at the PLC, which is a bearish signal, after this liquidity run, you can call it, or liquidity attack, and then a bearish signal at the PLC, which brings us to our next signal at the PLC, PLC protection, which is not an analytical use case, but we use it for execution, for a signal. Okay, so this is a bearish engulfing signal that printed at the red line PLC. That is a signal. There's another pin bar that printed. But you are seeing when price crosses the PLC, you are seeing protection of it. It crosses it again, and again is being protected. The PLC is being protected. That's a great sign for a entry regarding an execution use case. Volume can be used in many ways. These are just a few of them. Okay. We can also use it for targets, which is, let's look at this zone. Is this a very strong zone? Not really. If you want to draw it over here or like this, but this is a valid zone because it's a valid footprint. Now, how many previous structures did it break? Just one. Is it the strongest zone in the world? No, it's not. Okay, but it is a valid zone and a valid footprint. So what can you do if price were to come back to this valid zone? Maybe you would be looking for your entry on your micro, because this is a macro 4-hour zone, maybe a 15-minute entry. But we're not here for the entry. We want to use this volume for the target. Let's say somehow you manage to find the entry on the micro. Where is the target? Well, some of you may say here, and that's basically setting a target without using volume. Well, let's see if we can use volume to help us with the target. Now, this was definitely an origin here and some sideways stacking. Let's put volume across this entire cluster. And here is our PLC, our level of heaviest volume. And you can use that as a target if you are selling. So this is how we can use the PLC for targets and may be a little bit more accurate. So you can use it to refine the zones. You can use it to draw the consolidation and understand where the heaviest part is of the consolidation and how price may react to the liquidity above and below it. You can look at the POC shift and see if the POC shifted higher and then was completely engulfed, and there was a signal that printed at the POC. Or if we see price crossing the POC, and every time it does, somebody comes in and sells. It crosses the POC, somebody comes in. It crosses the POC again, somebody comes in and protects. POC protection. It's always good to see how price is reacting and playing around this area of the heaviest volume. And then again, like we said right now, targets, a great way to set targets. Yes, you could do this, but just to squeeze that little bit more accuracy, usually price does go to the area of the heaviest volume. So not a bad idea just to use that even as a target if you were to sell or if you were to buy. Something across here, although it's not too much volume here, but technically if somebody were to buy, not a bad idea to set that as a target, that POC there. Okay, so many ways we can use this volume, but volume, consolidation, liquidity, they all get tied up together. Understanding it, using it properly, whether it's for to refine your technical analysis, whether it's to find an entry, or whether it's maybe to find a target, volume can be a big tool for the trader. Although you can trade on pure price action candles, price action along with the volume, and these volume confirmations can really take your trading to the next level.